Hi, I'm Buckner, your economics instructor. And in this video, I want to discuss with you monetary policy. Monetary policy is an effort by the federal government to achieve a macroeconomic outcome by manipulating the money supply. The two macroeconomic outcomes that we're often looking at affecting are going to be inflation and unemployment. In this video, I'm going to discuss particularly employment, or should I say unemployment. So, with monetary policy, what the federal government through the Federal Reserve Bank will typically do if it wants to create expansionary monetary policy, which is what it would do if it wanted to reduce unemployment, is increase the money supply. So if the federal government increases the money supply, an effect is going to be that banks have more money available to lend. So if banks have more money available to lend, they're going to be more aggressive in trying to find people to lend it to. One way that they are going to try and find new borrowers to lend that money to is to offer lower interest rates. If banks offer lower interest rates, it makes it cheaper for individuals and for firms to borrow money. So one thing to note, if we look here at our aggregate market graph, is our aggregate demand curve. So our aggregated or combined measurement demand looks at our demand for consumption goods, investment goods, and government purchases, as well as our net exports. So I want to focus, when I talk about monetary policy, on this investment goods component. So an investment expenditure is going to be something like building a new factory or buying a lot of new equipment for an existing factory. The majority of investment expenditures in the United States are paid for with borrowed money, which is to say that firms don't typically have enough cash on hand to pay to build a new factory. If a firm wants to build a new factory, they're going to have to go to a bank and borrow a large sum of money in order to pay for that new building. So if through monetary policy, the federal government can make it so that the interest rates on borrowed money is lower, they are able to reduce the borrowing costs for firms when they go to make investment expenditures. If you can make investment expenditures less expensive for firms through reducing their interest payments, you're going to encourage them to make more investment expenditures. So an expansion of the money supply is going to have lots of effects in the economy, but one in particular is you're probably going to see an increase in investment expenditures. Now, because investment expenditures is one of our component of our aggregate demand, if that gets bigger and nothing else changes, aggregate demand is going to shift to the right. Think about this AD2 representing what aggregate demand would be with this increased amount of investment expenditure. Now, go back to the original black aggregate demand line. Where aggregate demand intersects your short-run aggregate supply on your x-axis, that gives you actual GDP in an economy, which is a measurement of how much stuff gets produced in an economy. If we want to focus on labor and employment, if we go from making this amount of stuff to some increased amount of stuff, firms are probably going to have to hire new workers to make this additional stuff, right? For example, building these new factories. If firms wind up hiring new employees, you're probably going to see the effect of the unemployment rate falling. So one of the common uses of monetary policy is to try and manipulate the money supply with the ultimate desired effect of seeing GDP increase, which will cause unemployment to